September 25, 2008, Washington, D.C. In a late-night emergency meeting, federal regulators informed executives of Washington Mutual that the bank would be seized. By the next morning, deposits totaling more than $300 billion were under federal control. It was, and remains, the largest bank failure in United States history. Customers woke up unsure whether their bank still existed. Investors saw billions in equity erased. Within hours, the Federal Deposit Insurance Corporation had transferred most of the bank's operations to JPMorgan Chase. To understand how Washington Mutual reached that moment, you have to rewind several years. During the early 2000s, the U.S. housing market expanded rapidly. Mortgage credit became widely available. Financial institutions competed aggressively for market share. Washington Mutual, commonly known as WAMU, positioned itself as a leading mortgage originator. According to regulatory filings and subsequent investigative reports, WAMU expanded aggressively into higher-risk mortgage products, including option adjustable rate mortgages and subprime loans. These products often allowed borrowers to make lower initial payments, with balances potentially increasing over time. At the time, housing prices were rising nationally. According to publicly reported housing data, home values increased significantly between 2002 and 2006. Rising prices masked underlying credit risk. Borrowers who faced difficulty could often refinance or sell at higher prices. In this environment, growth appeared rational. WAMU's leadership pursued expansion. According to SEC filings from the mid-2000s, the bank grew its loan portfolio rapidly. By 2007, Washington Mutual had more than $300 billion in assets and operated thousands of branches. Nationwide, incentives aligned with volume. Mortgage origination generated fees. Selling loans into securitized markets transferred risk off balance sheets. Shareholders rewarded growth. Compensation structures across the industry often reflected production targets, but structural weaknesses were building. According to reports issued later by congressional investigators and regulators, underwriting standards weakened across parts of the mortgage market. Adjustable rate mortgages exposed borrowers to payment shocks when interest rates reset. Option ARM products allowed negative amortization, increasing loan balances over time. WAMU was not alone in these practices, but its scale made it systemically important. By 2007, housing prices began to plateau, then they declined. As home values fell, refinancing became more difficult. Borrowers with limited equity faced stress, according to regulatory disclosures and subsequent reviews. Delinquency rates on subprime and option ARM loans began rising sharply. Losses mounted. WAMU reported increasing provisions for loan losses in 2007 and 2008. According to financial statements filed with the SEC, credit quality deteriorated as defaults increased. At the same time, funding conditions tightened. The secondary market for mortgage-backed securities weakened significantly in 2007. Investors demanded higher yields to compensate for rising default risk. Liquidity across financial markets declined. WAMU attempted to raise capital. In April 2008, the bank announced it had secured $7 billion in new capital from investors including private equity firm TPG. According to SEC filings, the capital injection was intended to strengthen the balance sheet and reassure markets. It bought time. It did not reverse credit deterioration. Throughout 2008, the broader financial system faced escalating stress. Bear Stearns collapsed in March. Fannie Mae and Freddie Mac entered federal conservatorship in early September. Lehman Brothers filed for bankruptcy on September 15th. Confidence across financial institutions eroded rapidly. WAMU's stock price declined sharply. Depositors began withdrawing funds, according to later FDIC documentation. The bank experienced significant deposit outflows in the days leading up to its seizure. By late September 2008, regulators concluded the bank was no longer viable as an independent institution. On September 25th, the Office of Thrift Supervision closed Washington Mutual and appointed the FDIC as receiver. JPMorgan Chase agreed to purchase substantially all of WAMU's banking operations for approximately $1.9 billion. According to FDIC press releases at the time, shareholders were wiped out. Bondholders faced losses. Depositors were protected. The size of the failure reflected years of accumulated risk. Washington Mutual's growth strategy relied heavily on mortgage lending during the housing boom. As housing prices rose, credit risk appeared manageable. As prices fell, Weaknesses in underwriting and product design became visible. Incentives rewarded expansion. Market conditions masked fragility. Regulatory oversight at the time operated under frameworks that did not fully anticipate the scale of mortgage-related systemic risk. By the evening of September 25, 2008, the largest bank failure in U.S. history had been executed. In a single day, Part 2 examines the mechanisms that turn credit deterioration into institutional collapse, the regulatory framework that governed thrift institutions, and the structural vulnerabilities exposed during the crisis. By early 2007, the stress inside Washington Mutual was no longer theoretical. It was embedded in the structure of its balance sheet. The bank's business model had become heavily concentrated in residential mortgage lending, according to regulatory filings and public financial statements. WAMU held substantial volumes of option-adjustable rate mortgages and subprime loans, particularly in high-growth housing markets such as California and Florida. Option A or MIS allowed borrowers to make minimum payments that did not fully cover interest. The unpaid portion was added to the loan balance. In a rising housing market, this structure appeared manageable. Borrowers could refinance before principal balances grew too large, but when housing prices stalled and then declined, the math changed. According to reports released later by the Senate Permanent Subcommittee on Investigations, internal reviews, and regulatory examinations identified elevated risk within certain loan categories. Rising delinquency rates began to appear in 2006 and accelerated in 2007. Losses did not materialize instantly. Mortgage defaults typically unfold over months. However, once property values began falling nationally, the protective equity cushion eroded. WAMU began increasing its loan loss provisions. According to SEC filings in 2007, the bank recorded billions of dollars in provisions to cover anticipated credit losses. Earnings declined. Investor confidence weakened. At the same time, the secondary market for mortgage-backed securities deteriorated. Many financial institutions had relied on securitization to distribute risk. As investor appetite shrank, liquidity across mortgage markets contracted. Washington Mutual still held large volumes of mortgages on its own balance sheet. Capital became critical. In April 2008, WAMU announced the $7 billion capital infusion from outside investors. According to regulatory disclosures, this capital was intended to stabilize the bank and absorb mounting credit losses. However, capital can only offset realized and expected losses to a certain extent. If credit deterioration accelerates, additional capital may be required. By mid-2008, the broader financial environment had worsened significantly. Lehman Brothers' bankruptcy on September 15th triggered extreme volatility across credit markets. Interbank lending tightened. Funding costs rose. Depositor behavior began to shift. Although WAMU was primarily a retail bank with a broad depositor base, confidence in financial institutions had eroded nationwide. According to FDIC documentation released after the seizure, Washington Mutual experienced approximately $16 billion in deposit withdrawals in the 10 days preceding its failure. In banking, liquidity is paramount. Even solvent institutions can fail if deposit outflows exceed available liquidity. Regulators monitor capital adequacy and liquidity buffers to assess viability. By late September 2008, the Office of Thrift Supervision determined that WAMU was in an unsafe and unsound condition. According to FDIC reports, the bank was unable to secure sufficient funding to meet obligations as losses mounted and deposits left. The regulatory framework is important to understand. Washington Mutual was regulated primarily as a thrift institution under the Office of Thrift Supervision, rather than as a traditional bank supervised by the Office of the Comptroller of the Currency. Thrift institutions historically focused on residential mortgage lending. In subsequent congressional hearings and oversight reports, questions were raised about regulatory supervision, risk concentration, and whether earlier intervention could have limited losses. According to later investigative findings, regulators had identified certain risk trends but did not require aggressive corrective measures. Before the crisis intensified, the decision point came quickly. On September 25, 2008, regulators concluded that WAMU no longer had adequate liquidity to continue operating safely. The FDIC was appointed receiver and immediately arranged the sale of most assets and deposits to JPMorgan Chase. The speed of the transaction was deliberate. Unlike the bankruptcy of Lehman Brothers, which created global disruption, regulators sought to avoid market chaos by transferring deposits, and branches overnight. Authorities aimed to preserve stability. The mechanism of collapse was not fraud, it was the combination of credit deterioration, concentrated exposure to high-risk mortgage products, declining housing prices, and funding pressure during a systemic crisis. Incentives during the housing boom encouraged growth in higher-yield products. Risk management models often relied on historical housing price stability assumptions. Stress testing frameworks at the time did not fully incorporate nationwide home price declines of the magnitude that occurred. When those assumptions proved flawed, losses accumulated rapidly. Washington Mutual's scale amplified consequences, with more than $300 billion in assets. Its failure required coordinated federal action. Part 3 examines the aftermath, the regulatory response, litigation that followed, and how the largest bank failure in U.S. history reshaped financial supervision. September 26, 2008, branches that had carried the Washington Mutual name reopened under new signage. JPMorgan Chase assumed control of deposits and most banking operations overnight. Customers retained access to their funds. The transition was structured to avoid panic. Behind that seamless appearance was one of the largest resolution operations in U.S. banking history. According to the FDIC's official statement issued on September 25, 2008, Washington Mutual was closed by the Office of Thrift Supervision, and the FDIC was appointed receiver. JPMorgan Chase agreed to purchase substantially all of the bank's assets and assume its deposits. For approximately $1.9 billion, the transaction excluded certain holding company obligations. Washington Mutual, Inc., the parent company, subsequently filed for bankruptcy protection. Court documents showed complex litigation between creditors, shareholders, and bondholders over asset recovery and claims distribution. Those proceedings continued for years. The direct cost to the deposit insurance fund was limited relative to the size of the institution because of the structured sale. However, the broader systemic cost of the 2008 crisis was far larger. Washington Mutual's failure occurred during the most acute phase of the financial crisis. Lehman Brothers had filed for bankruptcy 10 days earlier. AIG required federal assistance. Credit markets were under severe stress. Confidence across institutions was fragile. Regulators faced a difficult balancing act. In SEC proceedings and congressional hearings that followed the crisis, lawmakers examined the regulatory structure governing thrifts. Washington Mutual had been supervised primarily by the Office of Thrift Supervision. After the crisis, that agency was dissolved under the Dodd Frank Act, and supervisory authority was redistributed. The Dodd Frank Wall Street Reform and Consumer Protection Act, signed into law in July 2010, introduced enhanced capital requirements, stress testing mandates, and the creation of the Financial Stability Oversight Council. According to regulatory releases, the legislation aimed to reduce systemic risk and strengthen oversight of large institutions. Washington Mutual became a case study in risk concentration. The bank has heavy exposure to option adjustable rate mortgages, and subprime lending magnified vulnerability when housing prices decline. Nationwide, risk models that relied on historical regional diversification assumptions proved inadequate when losses became correlated across markets. Incentives during the housing boom rewarded loan volume and short-term profitability. Capital markets provided liquidity for mortgage securitization as long as housing prices rose. Credit deteriorated and appeared contained. When home prices fell broadly and refinancing channels closed, losses accelerated. Investigations into mortgage origination practices across the industry resulted in multiple enforcement actions. DOJ filings stated that several large financial institutions entered settlements related to mortgage underwriting and securitization practices in subsequent years. Washington Mutual's role was part of that broader narrative of aggressive lending standards and insufficient risk controls. However, the largest bank failure itself was executed through regulatory seizure rather than criminal prosecution of the institution as a whole. From a systemic standpoint, the failure demonstrated three key structural lessons. First, asset growth concentrated in a single sector can amplify downturn risk. Washington Mutual's expansion into high-risk mortgage products left limited diversification buffers when housing prices decline. Second, liquidity remains decisive. Even institutions with significant retail depositor bases can face rapid withdrawals when confidence erodes. Approximately $16 billion in deposit outflows during the final days, according to FDIC documentation, accelerated the resolution decision. Third, regulatory frameworks evolve after crises. The The thrift supervisory structure that existed before 2008 was fundamentally restructured in the aftermath. In the years that followed, stress testing became a central regulatory tool. Large banks were required to demonstrate resilience under severe economic scenarios. Capital requirements increased. Mortgage underwriting standards tightened across the industry. The failure of Washington Mutual did not trigger the crisis, but it reflected the scale of excess built during the housing boom. More than $300 billion in assets were transferred in a single resolution. Equity holders were wiped out. Creditors faced extended bankruptcy proceedings. Depositors were protected through federal insurance and structured sale. It remains the largest bank failure in U.S. history by asset size. Today, when analysts evaluate financial institutions, they examine capital ratios, liquidity buffers, loan composition, and interest rate exposure through a post-2008 lens shaped in part by WAMU's collapse. The episode underscores a recurring theme. In financial history, rapid growth during favorable cycles can conceal structural fragility. Risk often accumulates gradually, then surfaces abruptly when conditions change. Understanding the mechanics of the largest bank failure in U.S. history provides context for how regulators and institutions approach systemic risk today. If you value fact-based, carefully sourced analysis of major financial events, consider subscribing to the channel for future documentaries.